Okay, let's also bring on board Prateek Agrawal, who joins in on the show to decode the markets and the road ahead. And Prateek, just wanted to get in your take as to how you're looking at the overall sentiment. There have no doubt been a lot of intent from the government, rollback of FPI, spurring growth within individual sectors like autos, consumption, real estate to a certain extent. Why is this not really reflecting on the movement in the markets?
How should I say this, but sentiment is a weird thing. The increase in tax in the budget was of the order of 12,000 crore and the damage to the market cap has been in the order of 12 lakh crores. Now what you have given back is 1400 crores, and I did believe we had one day of rally. So it has to be seen in the context. We had a beautiful setting with the government coming back with the kind of majority it did. People were feeling good and positive, and then all of that positivity got lost because of the kind of budget we had. Now it is a difficult period. Global growth is not supportive, and the Indian consumer and industrialist has gone into a shell. So a small tweak of surcharge, and that too only on capital gains, is not going to help. Second, you had this BTC paper which comes out, and the taxation on dividends, which is post-tax, this is a taxed income. It will not be taxed in the hands of the corporates, very good, but it will be taxed at the marginal tax rate in the hands of the individual. What are the kind of suggestions that are coming out? So frankly, I would urge, speaking to people who invest, who build this economy, as to whether they are feeling positive about doing so, and we do believe they have gone into a bit of shell.
I wouldn't say that, Prateek, because time and again you are hearing one or the other government spokesperson come out and actually say that they've very well taken cognizance of the state of the economy and they would really do whatever it takes. Even as of last evening, you had the Finance Minister Nirmala Sitharaman speak at a very public platform. The bite has been circulated all over the media, and she's promising that more steps to boost the economy would be undertaken. She said that the Modi government is responsive to stakeholder concerns and is aware of the slowdown. Also assured to pump up infrastructure spending. Yes, I agree with you that the mood is really all that beaten down that these soundbites also perhaps may not help. But aside of that, Prateek, would you also believe that maybe part of the worry is also what was handed out in the RBI annual report yesterday. The fact that RBI is saying that there is very little elbow room or actually zero scope of any other further fiscal stimulus because the state governments as well as the central government reserves are pretty tight at this juncture.
No, what they are saying is correct. If you want to be fiscally prudent, which is good, we are seeing interest rates go down, which is good, but then where is the space for fiscal stimulus, especially when economy is slowing and versus your expectation you will probably get lesser taxes. Thing is, if you look at the trends over past several years, it's not exactly what happened over the last 5-6 months. You are looking at saving rate go down. Okay, which kind of means that people have been consuming, using a part of the saving pool that they had, and that was clearly not sustainable forever. From 30+%, we are down to 17%. So that is a structural issue that is facing the economy policymakers just now. The second thing that I want to say is, yes, government is doing a great job, but what is the total government revenue as a percentage of total GDP? 13-14%. Of that, a large part is salaries and interest rates, interest payments. Very little is left to do an incremental gain in the economy itself. It is rest of 125 crore Indians which have to participate and contribute to the economy. And what happens is, if you are feeling good, you do that bit more. If you are not, you don't do that bit more. And that is the delta which is dragging us down.
Okay, I wanted to draw your attention then to what's going on within the cement basket, because you seem to be a bit bullish on this sector, and we do have a lot of market participants as well who are acknowledging the space as a whole. Demand, of course, is going to be the key going forward. What exactly is your outlook, and which are the cement companies that you would be bullish on? Would you be going for some of the mid-cap names as well?
So yes, we are positive on cement. It's one way of playing the capex theme. Capex is something which is being driven by the government primarily at this stage. Be it roads, ports, whatever happens, cement is one ingredient which will go in. Hopefully we see uptick in the real estate situation as well. It's been a while since lending rates for real estate were in the vicinity of 8% or maybe even lower. So we should start to see some uptick in the real estate space that once again benefits cement. So that's a space we like. We like the larger names in this space rather than the small names. But that said, if volumes pick up, if prices are higher from where they are, everybody will benefit. What is happening is the larger ones are the ones which are able to scale up. If you look at how the market shares have moved, it's been a consolidation with the larger names, and we believe that will continue. So for long-term investing, that is where one needs to focus on rather than the mid and small. On mid and small, frankly, if you look at this result season, you would see that the larger names in a space have delivered much better numbers versus the not so large names. We believe the reason for that is the changes in the marketplace, maybe driven by regulation, maybe driven by regulators, policymakers, etc., which larger companies are able to take care much better versus the smaller companies. So we are more focused on the larger names just now.
The view coming in on the cement space. In fact, let's just look at what's going on with the markets at the current juncture. We're holding out by 0.5%, mind you. We got off to a quiet start and now seem to be building onto that momentum. You do have the broader end of the market as well that's showing you a convincing move. And in terms of sectors, it's really all around that you're garnering support. So metals are taking the lead this morning. You've got FMCG as well, which is contributing. Take a look at the Nifty Bank at around 27,500. Real estate, auto, all of them really packing in a punch. From the frontliners as well that are taking charge, it's a long list of names that are holding out in the green. Tata Steel, of course, driving the gains on the metals index, giving it companies something like Vedanta, Hindalco and JSW Steel. You've got Yes Bank at 58, very crucial as to what emerges from that AGM. Britannia's is showing you some fervor, and then you've got Bajaj Finserv, HDFC Bank as well as ICICI Bank, and something like Hero as well as L&T lending a helping hand. As I said, there's a lot of movement in the broader end of the market. It's a lot of, it's tending to be fairly stock specific by way of newsmakers. So CCD, Jet Airways under quite a bit of pressure on the back of that news. Adani Green Energy, though, is hogging the limelight on the back of that deal that they've undertaken with the SL Group. You've got something like CG Power, which is looking active, J&K Bank in the green, and select names from the sugar basket like Sri Renuka as well are active. You've got Lemon Tree as well, which is after yesterday's move, seeing some reprieve in trade. DHFL as well continues to remain quite active in today's trading session. Meantime, wanted to get in your take, Prateek, as to how you're looking at what's going on within the MDFC space. You know, we're going to have a detailed discussion down the line as well with Rashesh Shah, who will be joining in. But in the meantime, lots of steps or lots of intent has been taken by the government in order to revive the sector. We're seeing the ripple effects still playing out, of course. There's that liquidity crunch in the system that's very evident. When do you think that we are likely to see some sort of a silver lining emerge? And do you think that it's the right time to buy some of the good quality NBFCs?
Yeah. Now this is a space we have been very positive upon. We continue to be positive. One reason why this space did languish for some time was the fact that interest rates moved up, and for a brief period banks found it better to lend to RBI rather than lend to NBFCs. So NBFC's cost of funds simply moved up very, very sharply in that period after the ILFS crisis took place. That's reversed now. The GSEC rates, 10-year GSEC have fallen 6.5% and the risk weightage for NBFCs which are better rated has moved down because now it is linked to the ratings themselves. So many NBFCs are able to source bank funding at rates lower than what was there before the ILFS crisis. I think the number of NBFCs which are able to do that will increase going forward as the government recapitalizes banks. 70,000 crores has been promised there as well. So that is something which makes us very, very positive on NBFCs which are good. So NBFCs can be put into two baskets, one which nobody will touch and nobody will lend at any rate. Developer financing, loan against shares kind of activities which are seen to be very risky at this point in time. However, stuff like gold finance, microfinance, two-wheeler finance, consumer durable finance, CV finance kind of activities are maybe even LAP done well are activities which are seem to be safer with no ALM mismatches and scalable. So NBFCs which are focused there should continue to see decent growth momentum and improved margins, not maybe in the second quarter but as we go forward, and that should help overall profit delta. So that is a space we have been positive upon.
Okay, fair enough. That's the take coming in. In the meantime, Prateek, wanted your outlook on IT as well. Where is it that you're seeing promise coming in? Because, there are recent reports as well indicating that Indian tech companies are exchanging more client to and from MNCs as well as some of the big tech firms. The seniority and of change as well as the extent of the competitive loss has been the highest at TCS. What is your take in light of this theme to look at IT?
So if we look at IT versus rest of what we have, and what we have is primarily financials and consumers, then the growth in IT seems to be sub 10, maybe higher than some consumers, but most consumers are able to grow faster than what IT businesses are able to grow. If I look at only the IT space, we believe the larger ones are able to deliver sustained growth in profits versus the not so large ones where it can be very, very volatile. So we are focused on the larger names, two larger names frankly, and as a house on only one of these names. So we have stayed underweight this space for now 3 to 4 years, and the reason being that the CAGR earnings growth that we have seen is significantly below our desired growth rate. These are very good quality businesses, but our thesis on growth is significantly below what we desire as a minimum from our investments.
Right. But then what's the message out to the investors out there? Is this time to actually profit take, if at all you're sitting on any profit from any of the mega caps or the large caps in particular? And has the time now come to deploy some of your money into mid and small caps? Is there a higher degree or chance of a higher degree of outperformance there, or would you say stay put because large caps are the safest?
Yeah, so let me articulate my point of view there. One, what has happened is bond yields have cracked big time, and on an indicator which compares bond yields with earning yield, we are looking nicely priced, even cheap. So last time also I said we should not expect markets to fall, and this time around also I'm saying the very good chances markets sustain at the current level, maybe move up a bit. Two, if you look at where the numbers are coming from for our portfolios, which is focused, like I said, on consumers and financials, all of the small variety, not small cap but small ticket sales, we have seen an EPS growth of 22% for our holdings, and versus that the index has done just about close to zero. If you net off financials, index is negative in a big manner. We are up like 7%. So for growth investing, we believe consumers and financials have this space to be in. Financials have a great combination of continued growth and decent valuations. Consumers, we do believe, are on the expensive side. So that is the space to be focused on. Is the market going to gallop away in the near term? Probably no, but is it a good time to come into the market in a structural manner in the form of SIPs? I would definitely say so. Sentiment got distorted for small reasons. It can also get built for small reasons, and like I said, valuations are now much more defendable versus earlier, and people should come in. Mid cap versus large cap, we are completely focused on large cap. Mid caps, let me just say a point. What did well in 94 was cement, never did well after that in the mid cap space. What did well in 2000 was small cap IT, never did well after that, many evaporated. 2004 to 7 real estate and construction, never did well after that, and so on. So the point is that in mid caps you get very good period, but at the beginning of the period you get a big theme, and as of now we are not seeing a new theme emerge in that space, and that makes it a very, very difficult space to my mind, and it could continue. So
that's the take coming in. Thanks very much then, Prateek, for joining in and digging out whatever opportunities that you can find and giving us your view on the markets. It's been a pleasure having you on ET Now.